Okay, time for a Q&A session from the last market outlook. This one I'm going to do on a separate screen because it is useful. Please help with the calculation from CME Treasury Analytics, the dollar value of an 01, which is a basis point value on the cheapest to deliver for ZBH5. That's the T-bond contract, the March contract. 122.15. I have it as 121.26 by the time I answer this question. There's the futures DV01. This is the cheapest to deliver here, and this is the futures that in reference. That's the coupon of the cheapest to deliver, the maturity date. The futures price 112.03. We'll see a little bit more down here. That would be the dollar value of an 01, 121.26. Let's see, yield was 4.91, 4.85 on the 20 to 30. What yield do we have here? We have on the cheapest to deliver 4.9263 on the cheapest to deliver. My question, if let's say both rise by another 100 basis points, roughly the loss on one ZB contract will be 12,215. Yeah, that's about right. Understand every tick is 31.25. Struggling to calculate how much a tick change per basis point value in the 20 to 30. The easiest answer is you simply take the 121.26, and if you know that each tick is 31.25, it's every 3.88 ticks, or 4 out of 32. But we can get there if we didn't know that. We can get there another way. We can notice down here on the sensitivity, at the money we have a yield 4.92. If it drops from 112 to 111, a full point here, there is the yield 5.0079, which is 8.16 basis points. Multiply by the futures, the DV01 121.26, you get 989.40. Since each tick is 31.25, there are 32. Going from 112 to 113 or 112 to 111 is either a gain of 1,000 or a loss of 1,000. We're at 989.48, and that is because the futures doesn't. If you're using DV01, you don't get any convexity in there. If you were using basis point value, it will import convexity because basis point value is calibrated for 100 basis points. And then you simply just divide it by 100 to get a basis point value. So you are importing convexity into every basis point, whereas the DV01 is calibrated to 1 basis point. So you end up with, if you multiply it by 100, because you're saying 100 basis point change, if you multiply it by 100, you actually import no convexity. But here it is bringing in some of the convexity. So 989.48 is close enough to 1,000, right? And that is 8.16 basis points. So if we take $1,000, which is the change, and you divide it by 121.26, which is the DV01, you get 8.2467, or every 8.25 basis point change in the yield on the cheapest to deliver will be $1,000 gain or $1,000 loss. So you could just do a ratio, 8.24 to 32, because there are 32 ticks, is 1 to x. We solve for x, we get 3.88. Again, you take the 121 divided by 31, you get 3.88. So roughly about every 4 basis points change in yield on the cheapest to deliver is equal to, every 1 basis point change on the cheapest to deliver will be about a change of 4 ticks. So you'll go from 112, let's say it's at 432, and the cheapest to deliver changes by a basis point. This will drop to 0 over 32 if you increase by 1, right? Yields up, price down. This would drop to 0 over 32. If you increase another basis point, you'd be 111 and 28 over 32. Okay, let's cycle through the questions. I'm using both formats. Sometimes if there's really good questions, let's expand it out into a full screen. Oftentimes, I can answer them just on the white screen that I have here. The questions for a while had gotten, less interesting, but lately they've been really good. So I don't mind cycling through them. What are your thoughts on intangible assets as an explanation for why US has outperformed and why the PE ratio of the SPX is less relevant today than historically? There's a podcast episode on excess returns, which has some interesting ideas and research on quantitatively using intangible assets as a means of explaining many divergences of value stocks, emerging markets, small caps, from how you expect them to perform. Well, the PE is an earnings multiple, right? It's you're looking at your earnings, so whether, let's say, it's net income, and if you're doing it per share, and then you're multiplying it by some multiple. So we have to have some explanation of, well, if we think it's intangible assets, how do these intangible assets find their way onto the income statement other than just in amortization? If you've purchased intangible assets on your balance sheet, you have a clear asset that's listed. If you have internally developed intangible assets, you have no asset on your balance sheet. So if we think, this is what we should see, if we think that there is something to this story for U.S. companies with intangible assets, and especially internally developed intangible assets, we should see exceptionally high return on assets, because the intangible assets must be generating some type of revenue to end up showing up in net income. If the intangible assets generate no revenue, then what are you paying for them for, right? I mean, if it's just a bunch of artwork hanging on walls that the CEO painted and it's all hanging on walls and we think it's worth millions and millions of dollars, if it's not generating any revenue, it's not showing up in the PE. So for it to show up in the PE or the forward multiple, there must be some anticipation that those intangible assets can be monetized. So this would be a footprint of something like that if you have a high RO, a high return on assets, because they wouldn't be listed. I can see, especially when you get to the idea of data combined with AI, that companies with large amounts of data will be able to monetize that data somehow through AI. All you have to do is make that sentence. You don't actually have to say, well, hang on, how and how much will it cost? So let's say that you have a whole bunch of data and you say, we haven't even begun to use the data we have. Well, what if it costs you $100 billion to monetize the data that provides $90 billion in revenue, right? It's the cost of getting it done. I can say to you, I grant you a license for all the gold in the ocean. It's all yours. And by the way, there's a lot of gold in the ocean, a lot. But the price of gold would have to be $15,000 an ounce to even make it worth getting out of the water. So would you then begin to value the ocean based on the amount of gold that's in there? Probably not, because gold is not $15,000 an ounce. How much is it going to cost to monetize that data? I think that is what's being missed. So if the expectation is in there, and that's why the market is trading at 22, 23 times forward earnings, okay, I can see, because the market is forward looking, it's anticipating that, but it should also anticipate the cost of getting that done as well. And that, by the way, would lead to a lower return on assets, because you're taking your internally produced data, which is not listed on your balance sheet, investing in compute power to get this done. You're turning this intangible asset into a fixed asset all of a sudden, which will have a stream of depreciation associated with it. I think that's the missing part, because right now it's super expensive to mine all that data. Other than that, I haven't heard the podcast for this one. Or the argument for this one. But sure, if you think that a lot of your internally developed intangible assets will produce a revenue stream in the future greater than the cost it would take to produce that revenue stream, okay. But at some point, that revenue's got to show up. Longer form video exploring the merits of active versus passive investing and why you lean towards active. Especially appreciate your perspective on career implications. Do you see future opportunities for active management being confined to niche strategies like EM or small caps? Well, I do see Well, it's hard to answer this one way or another, right? So let's think about the rise of passive investing. Let's go all the way from very liquid large cap to small cap, all the way to private companies or private equity. Let's say we'll just stick with equities for now. The belief is that as you move from large cap down this way, you get to more inefficient markets, mostly due to lack of coverage or lack of liquidity. The more of these stocks that are in indexes and the more passive investing that you have, the less valuation matters, because you're simply just buying into indexes, which would seem to me a bigger opportunity for active investing. If everyone was active investing, I would say, what's the point? I may as well be passive. If everyone's passive, I'm going to say you have a whole bunch of buyers that don't care about value. Because they're simply just buying the ETF wherever the ETF is, and the ETF is holding the stocks in a certain weight, and the buyer of the ETF is not really concerned about the valuation of anything. I would then say at that point that opens up a big window for active investing that would then begin to move this way. Inefficiency would go from the less liquid markets to the more liquid markets, the more passive I think that the market becomes. However, if you have a market that's 80% passive and just putting money in the market all the time, I think it would be hard, unless you convince the 80% that there's trouble on the horizon, they start pulling their money out. It would be hard to bet against that. You almost have to go with it at times. But more and more passive investing, I think, would lead to greater runs up and greater drops down, because they don't care about valuation, don't care about valuation, don't care about valuation, don't care, until they do. Then I really care, and then they all just herd out the door. So I think you'd end up getting sharper peaks and sharper sell-offs. So for an active investor who is tactical, I think you could probably do quite well if everyone else is behaving passively. As far as future opportunities in the market, I am far removed from the job market, so I really wouldn't know about in terms of career. One of the arguments I've heard recently in favor of small caps, they tend to derive more revenue from within the U.S., and strong dollar benefits companies with more domestic revenue exposure. And I don't know that they benefit companies with more domestic exposure in as much as they don't punish companies. If you're consolidating and you have international operations and you're consolidating and you're translating different currency balances, a strong U.S. Creates a lower value for all those other currency amounts, whereas a small cap stock with very limited international exposure wouldn't have that effect. But on a weaker U.S. dollar, they also wouldn't have the effect of having a currency adjustment gain. I don't know that I would say it benefits them as much as it doesn't disadvantage them. And this will improve the earnings situation going forward. I don't see that. I don't see that at all. That's like arguing that a river would flow faster if we stop thinking about putting a dam in there. I mean, it wouldn't change the speed of the river just by thinking it. Seems a bit naive, contradictory to me, because it might be true. More revenue is from inside the U.S., and costs for imports or other costs of goods sold could be lower. But debt repayments would be higher due to elevated capital market rates, and small caps have more floating rate and other types of less favorable debt arrangements, making them more expensive to higher rates. Yeah, it is. They will have probably. They tend to have a higher cost of capital than large cap companies. They tend to not be able to attract the same type of talent that large cap companies can. So they tend to use a lot more share-based compensation to get that done, which dilutes ownership over time. They don't have the investment capacity to harness a lot of I guess, AI trend that's going on. They don't generate enough data, so if there is something there, they're probably going to lose out to the larger companies that can move faster than they can. But I don't know that I would go with the domestic currency argument, simply because larger companies do use currency derivatives to hedge out currency risk, and can even show gains on currency derivatives. I'm not after a CFA or continued CFA education. I wish you had a low-priced offering for those interested in your opinions on economic outlook and potential plays. Well, this is free on YouTube. That's pretty low cost. Has your view on agency changed? Do you still think the reduction in spread could provide price appreciation in the next few months? The market just doesn't seem to want to cooperate. I think rates are going a lot lower than where they are. I think that disinflation and even potentially deflation will be the top of the conversation in about a year. However, you can't fight the narrative that's going on right now. The market gets a hold of a story and then it just runs with it. All it takes is somebody to say, I think 10-year yields go to 5.5. Then somebody says, did you hear that? 5.5. And it starts to go around. Bloomberg saying 5.5. So this person saying, pretty soon the next day, Wall Street Journal's running an article, 10-year yields going to 5.5. That's how fast the narrative spreads. And suddenly everyone gets on board, doesn't question it. They stop thinking for themselves and off they go to 5.5. So if I had to bet right now, TLT higher or TLT lower? Lower. Agency higher or agency lower? Lower. Not because I believe it, but because everyone else believes the narrative that's going on. I'm absolutely certain interest rates in the U.S. are going to be 100 basis points minimum lower in 12 months than they are now. With one word, Trump. Did you catch his press conference today? For anyone thinking that Trump will be a more mellowed version of what we saw in 2016 to 2020, he will be a more ramped up version of that guy. That guy in 2016 to 2020 berated Powell for raising interest rates, and secretly he really wanted to be a dictator. Not anymore. Now he wants to be king of the world. Dictator's not enough. Today in his press conference, when asked if he'd rule out military intervention, he said no. In getting the Panama Canal and Greenland, he would not rule out military intervention. What about Canada? Oh no, that will be an economic war. I'm going to rename the Gulf of Mexico to the Gulf of America. Do you honestly think he's going to leave Powell alone if the market starts going down, if yields start going up, if inflation starts showing up? He's going to beat Powell over the head, saying it's your high interest rates that are causing inflation. Lower it, and he'll beat the hell out of them, like he did the last time interest rates went up. Interest rates are going down. Why? Because Trump wants them to go down. Trump wants them to go down, so they're going down. They're going down. Right? So I seem to think that everyone is just forgetting all that stuff and ignoring it and just attaching itself to one narration. Yields are going higher. Yields are going higher. Inflation, inflation, inflation. Strong growth, strong growth. I don't think you're going to see strong growth if he carries through with his tariffs and with his threats against the world. I think you'll see more and more U.S. isolationism and lower growth. You'll see disinflation and deflation, and Trump will do everything he can to juice the market, which means zero interest rates if he has to. Don't think that he is a more mellow version of what he used to be. He is an amped up version with manifest destiny in his mind. With manifest destiny in his mind. When you say, I'm not willing to rule out, when you say it as a president, military action against Denmark and Panama to get Greenland and the Panama Canal, right? And the more he says it, I think the more he talks himself into it. So, long question on agency. My view on agency hasn't changed. I still think there's value there, but when, sort of an old expression is, it doesn't help to be right in a room full of wrong people. And right now, everyone is focused on, oh, yields are going higher, therefore yields are going higher. Everyone's saying it, so it must be true, it's going higher. When the crowd goes to an extreme like that, they are mostly wrong. Okay. Do we have free will? Oh, that's a hard one to answer in this one. You could spend a whole 3-hour seminar on the conversation of free will by first of all defining what you mean by free will. You know, do you mean it in a philosophical sense, or do you mean it in a more practical sense, right? Already did that one. Thoughts on Chinese bond situation? 10-year bond yield is lower than '08, and their yields have also slipped below Japan's. Well, because China is shrinking quite quickly. I think they're shrinking faster. The rate of population decline is faster than Japan's. So they're facing the real possibility of deflation, which is a dangerous thing to be in. So if you have deflation, the value of their currency is increasing month after month. They're seeing that they can buy more and more assets. So why not hold back and wait a little bit longer? Maybe they'll get cheaper, which does end up with them being cheaper. So they wait longer and longer in case it gets cheaper, which does make them more cheaper. It is a downward spiral. So if you think that the 10-year is pricing in inflation, while it's pricing in negative inflation or deflation, that would lower the yield most definitely. $18 trillion worth of property value is gone since 2021. Yeah. How do I? Okay, this one has already been answered. Implications of the term premium in the Treasury curve in layman's terms. Isn't there always going to be some level of term premium as you go out on the curve due to maturity? Well, yeah, there will. The question is, well, what is the normal level of term premium? How do we compare term premium we're seeing now versus other periods in time? What is a fair amount of term premium? Right? The term premium is compensation against interest rate risk, not default risk now. That would be a credit spread, but interest rate risk, meaning if I buy a 10-year bond and interest rates change, the value of that bond will change. So I got to be compensated more than if I had bought a 1-year bond 10 times, because my 1-year bond's not going to change that much in price. But the yield I get when I roll it over in a year might be higher or lower. So the 10 years got to compensate me for some kind of risk of interest rates changing. Now, interest rates can go up or interest rates can go down. If you believe that over a 10-year period, it's more likely that rates will go up than rates will go down, the term premium should increase to compensate for that possible risk. So an increasing term premium over a period of time is a market saying, well, we think it's more likely than not that the average level of yields will be higher than what it is now over the next 10 years. Could you walk through the Chatham 1 month, 3 month SOFR calculation again? Well, I just use Chatham Financial because they have a nice forward curve. But if you're trying to figure out how much term premium, let's say a 1 year. Let's say we look at the 1 year, and let me find the 1 year from Friday. That yield was 4.18%. And we look at the 3 month, it's 4.34. So it'd be 1.0434 to the 0.2. We'll say 4. Actually, let me write it another way. 1 plus 0.0434 over 4. You multiply by 1 plus whatever the forward rate is in 3 months for the 3 month. Divided by 4, multiply that by 1 plus whatever the forward rate is in 6 months for the 3 month, divided by 4, multiply that by 1 plus the forward rate in 9 months for 3 months, divided by 4. And, without looking these up, we had a curve that was downward sloping like this. So it might have been 434, 420, 410, and 402 that you'd put in here. And you get a rate, let's say it's 4.12% by multiplying this out. this has no term premium in because they're 3-month rates. It's just a series of forward rates for 3 months. Then you'd say, well, there's 6 basis points priced into the 1 year. For the 2 year, you'd keep going. You'd multiply by 1 plus the forward rate in 12 months for 3 months, 1 plus the forward rate in 15 months for 3 months over 4. And then you'd look at the 2 year. The 2 year now, all rates are expressed annually. The 2 year is 4.28%, so you'd take 1.0428 and you'd square it to be able, because you're multiplying 8 quarters here, 2 years, or whatever you get here, you could take the square root of and compare it with the 4.28, and that'll tell you what term premium is in the 2 year. The forward curve goes out for 10 years, so you can calculate the term premium in the 10 year. It's a little bit more complicated than that when you go out that far. So let me show you something here. Let's get, what are we looking for? Give me a second while I click on a whole bunch of things randomly here. Here we go. Let me drag this onto the screen. Go to the Federal Reserve Bank of New York Treasury term premium, and they compare 2 models that were done by New York Fed economists, 2 papers and 2 models. So you can click on Explore the Data, and there's your term premium over time. The red line is the ACM term premium. You can download the data as well. You can download the Excel file. It has data for all the tenors. It's just, this is a chart for the 10 year. So if we, this goes all the way back to March of 1962. You could see how the term premium has evolved over time. But let's zoom all the way in. So notice here the term premium negative 1.357, and at the beginning of 21 it turned a little bit positive and turned positive there. Whenever we see that it's turning positive, remember October 2023 we had you had a bear steepener on the curve. That's it right here. This is the term premium increasing. Well, we have a bear steepener going on right now. Look what's going on here. So this was a big bear steepener here, combined with a bull flattener, a little bit of a bear steepener, bull flattener, bear steepener, bull flattener, big bear steepener, bull flattener, and now we're going into another bear steepener over here. There's the 0 line on the term premium for the 10 year. So right now we are at, as of December 2024, 4.88 or 0.488 on the term premium. If we go back over a period of time, there's the 0 line. It's hard to do it with this mouse, but you could see that horizontal line. Well, I'll move my mouse to the other side. There's the 0 right there. And you can see since about 2017, it's all the way to 2020, it went really negative. And it's been under 0 for quite some time. However, look back at 2008, 2010, 2014, it was almost 200 basis points on the term premium. Very steep curve, but money market rates were 0, right? We go back to this area right here. Let's go to September of 2007. The term premium was 1%. Yields were starting to increase. Central bank was beginning to cut rates. You had Lehman Brothers, and so as short rates dropped to 0, if you string out a whole bunch of zeros, you get 0. So any yield is all term premium, right? If your 3-month rate is 0.2%, and you look out over 5 years, and it's really just the forward curve is flat at 0.2. You're basically saying that anything is term premium at that point. So it looks like you had very high term premium, but you also had very, very low short rates. Here you have elevated short rates and you have increasing term premium. That can crush an economy. So you can spend some time with Federal Reserve Bank of New York Treasury term premium. You can download the Excel spreadsheet, and you can get all of them for all of the different tenors. Let's get back to where we were here. Let's get rid of this guy. All right. What would be a great area? Where's my mouse here? There it is. What would be a great area to focus on assuming there is interest for someone looking to do research in finance. As somebody who has done a PhD and has engaged in some research, I can give you some really good advice for this. Do what interests you, because research is about detail. It's about minutia. It can be excruciatingly boring if you're not interested in what you're researching. And I mean excruciatingly boring. You will start drinking. Out of sheer boredom, you're going to start drinking. So you better be interested in what you're researching. Don't ask somebody what to research. Ask yourself, what turns you on? What really excites you? What field interests you? What topic interests you? Research that. Explain how tariffs strengthen the U.S. dollar. Tariffs would strengthen the U.S. dollar by weakening other currencies. So let's say you have a market that is a critical market for a whole bunch of countries. They need to sell into that market. And you raise tariffs. There's that barrier to entry. Well, what you're going to do is you're going to increase the costs for people in this country, which means you might have more inflation, so you might have higher interest rates. But here, you're going to reduce growth over here because they're export-oriented economies, so they would start to reduce interest rates. A lower interest rate here, higher interest rate here, sell this currency, buy this currency. And let's make that the US dollar. Let's make this one over here Canada. Let's make this one over here Mexico. Let's make this one over here China. Let's make this one over here the EU. Why don't we just shorten it to rest of the world under Trump? Rest of the world, unless they become a state. If they become a state, then there's no need to put tariffs on them. How long do you think it'll be before Trump thinks that maybe Europe should be another state, that the U.S. should be a multi-continent country? How long do you think it'll be before he brings that up? Testing out the allocation factory, IBKR with SPY. Max amount they gave me is $350,000. You can change that. You can change it to whatever number you want. You have to go into the website itself, not through the system, but through the website itself, and you can change the amount to $1 million. You can change it to whatever you want. I've been making it so far by using puts after 2 weeks at a low strike. Well, you want at the money. If it's an allocation factory that you want, you actually want the stock, so you want to use a higher strike. Maybe use something of a lower price. Find something that has a lower price, that has weekly options. Try it with a good allocation factory right now might be on a Bitcoin ETF, IBIT, because it has momentum. Try it on something smaller. Is it better to choose close some puts? Yeah, just ignore all the rest of your question. I'm just going to ignore it. Just find a target that is lower in price. NVIDIA keynote speech at CES tomorrow could make things interesting. And it did this morning on NVIDIA, and it came right back down. Not only did it give up the big gain it had, it produced a nice big fat loss on the day. If you were to buy the stock and sell an at-the-money call and buy an at-the-money put, so your delta equals 0 in that case, fully hedging the value of the stock purchased, to receive the risk-free rate roughly 5.1% using January 2026 options. I doubt that. Your calculation is wrong somewhere. It is rare that something is completely at the money, right? So let's say you're looking at something that is $55.10 and you say, oh, I know what I'm going to do. I'm going to sell the call and I'm going to buy the put at 55. Well, careful, you got that dime in there, right? You're selling the call at 55, you're giving up that dime. So while it may give you the illusion that you're getting 5.1%, unless this is exactly $55 and you're selling the 55 and you're buying the 55 put, unless it's exactly like this, anything more than what a 1 year money market rate would be is an illusion. It means that you have some slippage somewhere that you're not aware of, and it's probably right here. It may also be in your bid and your ask. right? There's no guarantee you're going to get exactly the bid and the ask that you want, especially if you have to execute all three legs at the same time, which is typically what you have to do. I'd be very careful if you think you're getting 5.1. Check again, because even something like this, even being off by a dime, let me just calculate that for you and see what that comes to. That would be 18 basis points if you're off by a dime. So let's say you were looking at something at $55. You think you're getting 5.1 after 18 basis points. You're 4.92, and you're probably making some assumptions about what it's going to execute at, which could be another 20, 30 basis points here or there. Be careful. It would be odd on a risk-free position like that, using a synthetic. It would be quite odd that you're getting more than the 1-year rate, because these options are priced out with the 1-year risk-free rate, or the 1-year interbank rate, which would be 1-year SOFR rate, which is very close to what the 1-year Treasury rate would be. I'd be very, very careful if you think you're getting 5.1. Check again. If you're off on the stock, if the stock is not quite at the money, it's even worse if you think, well, it's 55.40, and I'll use the 55s. And hey, look, I'm getting 5.26%. Be very careful. Every dime is 18 basis points, right? There's 72 basis points right there that you're off on because you paid 55.40, but you got to sell it for 55. You're going to lose 40 cents right there. You've already agreed to lose 40 cents. So you're not really getting what you think you're getting on the call. I think you get my point there, right? If you're getting 5.1, there's a problem somewhere. I'm not clear on the applied level pricing. Website says 440 does not include new positions. It does up until the 15th, up until 11:59 on January 14th. As soon as we hit 12 o'clock a.m., that turns to January 15th, it's new pricing. I'm just going to put NP, new pricing, and the applied level splits into two, those that are only interested in asset management and those that are only interested in security analysis. So it does. Let's see, watching this after hearing Trudeau resigning. Wasn't that a party? Wasn't that nice? Right? That was fantastic. What took the kids so long? Do you think Pierre Poilievre stands a chance of turning Canada around or not? Yeah, I do. I think he does. What are your thoughts on selling LEAP options as a high-income earner? I'm not sure what that has to do with being high income. Usually if you're selling options, you sell short periods of time. I pay 50% marginal short-term rate, but only 23% on long-term. Oh, that's not going to matter. Let's say you sell a 10-year call. Let's say you sell a 10-year call today and you think, well, in 10 years I'll have to get it. No, you sold it today. You realize the gain today. You sold it today. Your buying is cost. Your selling is we'll just call it the price, right? Price minus cost, there's your capital gain. Well, if you sell with no buying, it's assumed that it's zero. So the moment you sell an option, you've realized the full capital gain at that point in time. So if it's, let's say, December, and you sell a put, a 1-year put, let's say it's December 2024, and you sell a 1-year put that expires December 2025, and you get $10,000 for selling. You sold a whole bunch of puts. You get $10,000. Well, that is income that belongs in 2024, all 10,000 of it. Which means that you have to close this out by buying. Let's say you bought it back for $9,800. Now your gain is only $200. So no, it doesn't work that way. And because it's a capital gain the moment you sell it, there is no distinction on options between short-term and long-term capital gains. They're all just capital gains. They are all just capital gains. So it really doesn't matter. Let's see. What is available out there to trade XL, Y, XLP ratio in the most optimal capital efficient way? Uh, is there a financial instrument specifically for that? Not that I'm aware of. Holding select sector ETFs at approximately the same percentage allocation as in SPY. That's going to be expensive. The XLs, all the XLs, whether you have XLY, XLU, XLI, XLF, all the XLs, I think the management fee is 30 basis points, whereas in SPY, I think it is 10 basis points. So you're spending a lot in management fees by doing that if you're holding them in the same proportion. And changing allocation of regular contributions to the portfolio, be overweight, underweight some sectors according to top-down analysis of the market. Well, then just buy SPY. And I'm just going to say you're going to buy 100 shares of SPY, right? And you want to be overweight. You think consumer discretionary will be good, XLY. Well, it'll have a weighting in the S&P. Just add 10 more shares. XLU, you think utilities will be good, add 10 shares there. You think that XL, let's say K technology will do very bad, short 10 shares there. And just underweight it. You could just do that. This way here you're paying 10 basis points over here and only 30 basis points on that lower amount. All right, and you could just, since SPY already has a weighting to XLY, you're just adding 10 more shares, suddenly you're overweight. So start from the core of SPY, there's your equal weight, and then you can just buy shares to overweight something, sell shares to underweight other sectors. Last year you mentioned you believe Australian miners would be an interesting play with the potential upcoming commodity supercycle as proximity to India. Yeah, Aussie has weakened recently. However, they're still yet to begin their rate cutting cycle. So it is holding up okay compared to other currencies. And just hear your thoughts on this play. Well, you know, here's the thing with Trump is Trump and uncertainty are basically the same word. So I don't know. Beats the hell out of me. Sometimes he does things because it's in line with policy. Sometimes he does things because it's in line with punishment. Whether he's going to do policy or punishment, I have no idea. His policy is give me Greenland. Denmark says, no, fine, I'll just punish you. Well, I mean, either you give me what I want or I'll punish you. That's his negotiating tactic. Is it going to work for the U.S. or is it going to work against the U.S.? I really don't know. Is it going to encourage global growth or is it going to hinder global growth? I don't know. You can make an argument either way. He is, I think, with his policies, last time he was good for U.S. markets. But was he good for U.S. markets because of the tax policy and the markets performed well despite his erratic behavior on everything else? He's putting a lot more loyalists in place than he had last time. I don't know. At this point, I mean, I really just don't know. I don't know what to expect from this guy, but you know, I think he could do with using fewer words. My honest answer to this is I have no idea. As long as the U.S. dollar stays strong, I don't know that non-U.S. miners. Well, I think non-U.S. miners would be okay, but I'm not sure that as far as investment goes, that you'd be willing to, you know, well, you're going to need U.S. dollars to get a lot of this done. Yeah, my answer is I don't know. That's the only answer I have, and when I don't know, I'd rather just stay away. I don't have any position on any miners. I did sell puts on gold futures today, 30-day, like as close to 30 days as I can, and I'm just going to keep rolling them at the money puts and just keep rolling them. Question regarding the overvaluation, inevitable price correction of mostly U.S. stock. Inevitable price correction. Well, okay, I'll accept it. Inevitable. There's no time frame on it. How much of an impact can we consider for EU stocks? EU stocks, I believe, are already undervalued, and I think I read something in Barron's. I think it was in Barron's. Deutsche Bank thinks or has said that the differential in valuations between U.S. and European stocks has never been wider, and that they are now overweight EU stocks. Are EU stocks also overvalued? No, to insanity. Or are they priced justly or even undervalued? Estimate from Deutsche Bank is they're undervalued about 5%. Yeah, so again, what's Trump going to do, right? Is he going to put tariffs on EU? He can't tariff the whole world. If he tariffs the whole world, the S&P 500 is a screaming short. America is a screaming short. The US dollar is a screaming short if he tariffs the entire world and then actually mobilizes the military to invade Panama, to take the. It's a screaming short. So I would seem to think that while the market in the U.S. is having trouble staying up, if it pulls back to reasonable levels, the U.S. is probably the best place that you want to be. But if we start seeing, as we head into inauguration, 605, 610, 615, 620 on SPY, I would then probably say it's time to start looking at other markets. Elaborate on what you mean by permissioned and permissionless. This is the difference between public and private blockchain. So the Bitcoin blockchain is a public blockchain with no centralized authority. So if you have a transaction, who's going to process that transaction? You have to incentivize strangers to do it. And to incentivize strangers to do it, the blockchain needs a native currency. Bitcoin is the native currency for the Bitcoin blockchain. There are 10,000 blockchains out there. I think there's something like 8 to 10,000 currencies, different cryptocurrencies. If you have a public blockchain, it needs a native currency to incentivize miners to process a transaction. And if you don't have proof of work, you'd still need some kind of native currency if you have proof of stake or proof of burn. There's a number of different techniques involved. But if it's private, in other words, it's permissioned, you can't. It's not public. You have to ask to join it. You join it for some particular for some particular reason. Then you do have a centralized authority, and the centralized authority, it's still a blockchain and still has all the cryptographic features of the blockchain. The centralized authority would process the transactions. Would validate the transactions and validate the block and add the next block to the chain. And then anybody who's permissioned to be on the chain will have visibility on the entire chain. So you can think of, supply chains. You could think of a situation where there's a group of people who need access to something. So let's say financial sector, let's say for banks that want to, let's say they want to securitize their loans. They may have those loans on a blockchain, not for the person paying the loan, but for credit analysts, for I guess private credit companies that may want to bid on some loans. So it would be a small ecosystem, and the bank itself would process all the transactions and add to the block. So that's the difference between permissioned and permissionless. Permissioned, you don't need a native currency. You have all the benefits of the trusted third party. With permissionless, the idea was not, we can't trust our third party. And that was never the motivating idea behind it. It was, in essence, a computer science problem. Is how would you do it online without the benefits of the trusted third party? How would you get that done? And that was a big computer science problem, and it was solved. Satoshi Nakamoto solved that problem. But in solving the problem, it was not a matter of we're doing this to get the hell away from the trusted third party. It was, here's a way to get it done without all the benefits of the trusted third party. Right? I think the future of this space, the blockchain, probably has some very good specific uses and will be taken up in a permissioned sense. All the permissionless ones, especially these intensive proof of work ones, I think will just eventually go away. Smart Centers REIT has a high payout ratio. It is a REIT. I mean, it is a REIT. Would this put the dividend in jeopardy? No, I don't think so. Let's have a look at Smart Centers here. Here is Q3 2024. 15.4 cents is their payout. I think their payout per month is 15.4 cents. Yeah. So 46 cents per quarter. This is FFO, and this is a diluted 55 is right around 56, 50, a little lower than the 56, 71 cents. If we look at the adjusted FFO, 61, 46, 48 is rather. So the payout is on average probably at about 100% of AFFO. But it is a REIT. It is a REIT that is not really involved in generating a lot of capital gains. So to keep their non-tax status, their REIT status, I believe 95% of their net income must be paid out, and their net income, I would hazard a guess, would be in line. Yeah. I'm just trying to think of the calculation from net income to AFFO. I think it would be in line. I don't see an issue here. Let's look at some things that they have. They also have a record of never cutting their dividend. They've never ever cut their dividend. Discount to net asset value 27.9% at $24.96. They're $24.50 now, so they have a nice discount to net asset value, 7.4 cents. 7.4%. Smart Centers has never cut a distribution since its inception. Let's have a look at who they have. 99%. They collect 99% plus of the rent. 95% tenants are national or regional. 45 come from the top 10. 60% of tenants provide consumers with essential services. Walmart. This is top 10 by revenue. 23.4% of the revenue comes from Walmart. That's not going anywhere. 4.6 from Canadian Tire. If I had to bet on one failing here, I'd say Canadian Tire. LCBO, they're not going anywhere. Sobeys, Best Buy. That's a small percentage. 113 shopping centers anchored by Walmart. Isn't that incredible? Also, major retailers currently accelerating growth. 9 deals with Costco over the last year. 9 deals with Costco. Costco's not going anywhere. Look at the names that you have here. These are solid names. These banks are not going anywhere. Gyms rarely go anywhere, especially bigger gyms. LCBO is not going anywhere. Shoppers Drug Mart's not really going anywhere. I like this little guy. I own it. I bought more today. I bought more of all the REITs today. I think I just said, give me an extra 1,000 shares of everything across the board, and I just picked up more. And I will keep buying them because it is a great alternative to holding on to cash. Great alternative. Let's see. Can you elaborate how commodity price will go up if the U.S. weakens? Said commodities will go up to be unchanged in other currencies. Sure. Let's say that I'm in, copper is $4 a pound right now, U.S. You have 1.435 on the Canadian, so let me figure out a Canadian price for copper. 1.435, 574 on this one. So let's say that, and you can do this with every currency to get a price of copper in either euros, pounds, Australian dollars. Since it's priced in US dollars, you can't have the price of copper staying stable in US dollars but changing in every other currency simply because the US dollar is changing. Typically, the price is more stable across all the other currencies, and it simply just changes in US dollars as the exchange rate changes. So let's say the US dollar weakens such that the Canadian dollar was now 138. Versus the 574. To keep a stable price at 574, the price of copper would now be 415 US. Without any change in demand anywhere in the world, if the US dollar weakens, such as the Canadian was at 138, to still be 574 Canadian per pound of copper, it would be 415 US. So the exchange rate gets smuggled into the price of the commodity. because you can't just have the price of the commodity just wildly fluctuating in every country with the exchange rate. The metals are usually fairly stable in all the currencies, but the price in U.S. dollars would absorb both the change in supply and demand and the change in the U.S. dollar. So you go from $4 to $4.15 if the U.S. dollar weakened. And that's just that 15-cent move is just on the U.S. dollar weakening. Article published by McKinsey, 2010, argues that analysts overestimate earnings by 10 to 12% on average. If we assume this is true for forward earnings on the S&P 500 and adjust forward earnings estimates downwards to account for the overestimation, forward P on the market would be even higher. Yeah, but the problem is that you have operating earnings and then you have the reported. The surprise factor, which means how much do earnings come in above the estimate, the surprise factor's anywhere from 3 to 6% above what the average of all the estimates were. So it's kind of hard to argue that the estimate average was overestimated by 10 to 12% when the surprise factor is 3 to 6% above what the estimate for operating earnings were for each company that is reporting. And the surprise factor has been positive for the last 4 or 5 years. I don't know that I'd look at anything at 2010 at this point. And it would also be, well, what look-back period did they use? If it was published in 2010, they probably didn't use data up to 2010. It was probably some look-back period. And if it included the .com, I would say you'd probably have to take that out. I've seen a chart of 10-year government bond yields of Switzerland and Germany, and for the first time in history, the yield for Germany is about 2 percentage points higher than the one for Switzerland. That is what deflation will do. Wall Street Journal had a story this morning in today's issue talking about the Swiss National Bank and probably more rate cuts to come because deflation is on the horizon. Deflation, all you can do is run to the zero line as fast as you can. You do not want deflation because that is a spiral. Because as soon as you see prices dropping, especially on big ticket items, you wait a month to see if they'll be lower. And if they are, you wait a month to see if they'll be lower. And if they are, you wait a month. You see where I'm going with that? Why am I going to pay $1 million for the house? In a month, it's going to be $950. And if it is, you think in a month it'll be $9. And it is. And then you think, high five, wait another month, I'll make another $50,000 because I could buy it for $850 instead. And then you keep waiting and waiting and waiting and waiting. And everybody keeps lowering prices to induce someone to buy, but everyone sees prices going down, so they wait even more. It's a bad place to be. Nothing but bad outcomes there. So yeah, you race to the zero line when you see deflation. China, Switzerland, Japan. Well, Japan's got inflation now, but they fought deflation for the longest time. Duration hurts big time right now, yeah. Do you see an end coming to it anytime soon? Not until Trump gets in office and not until he starts calling Powell names. You already had Michael Barr resign from as chair of bank supervision oversight because he would have been replaced anyways. Trump would have gotten rid of him. Trump probably want to replace him anyways. Trump unless the members of the FOMC travel to Mar-a-Lago, bend the knee and say, "What can we do for you, sir?" He will fire them all and replace them with people that he can call and say, "Do this, do that." That's who he is. So I see it ending when Trump finally shows up. Instead of the talk about what he's going to do, we will see what he will do. And more press conferences, please, because those are highly entertaining. I'm going to rename the Gulf of Mexico the Gulf of America. And I thought, who says this? It was funny. It was just funny. But yeah, I see it coming to an end as soon as Trump shows up and everyone says, "Oh, it's the same guy. Just worse. Oh, it's the same guy. We thought it would be different. It's the same guy." And then yeah, no matter what damage lower rates cause, It will cause higher valuations, and that's all he cares about. He's not going to balance things. He's not a man of balance. So yeah, I think we're going. As soon as he shows up. If I'm not wrong, I heard someone on Bloomberg say 5.25% target for the 2-year. Ooh, that is 100 basis points higher than where we are. I can't see that. I cannot see that. Can the 30-year go up another 100 basis points without breaking anything? I don't know. Probably not. Although I'd probably say, can the 10-year do it, not the 30? Struggling a bit with employee-based compensation. Employee-based? You mean stock-based compensation, L2. I think you mean stock-based compensation. Richie does a great job at explaining. It's still a bit tricky for me. Any advice? I haven't even looked at that reading. No advice, really. Anything about AI agents? Looks promising and might drive equities in 2025. I don't know. I've been totally disappointed with any AI agent I've seen. All it wants to do is direct me to frequently asked questions. Oh, you asked about this. Does this help? Nope, that's not what I asked about, and that does not help. Every time I see driven by AI, okay, never mind. I'm not interested. I don't know what looks promising there. I don't know. How do we navigate or manage the risk during earnings season? Sometimes, even if there's positive surprise, markets go the opposite way. Yeah, no kidding. And sometimes, as anticipated, yep. There is a random element to this stuff. And only after the fact, when you dissect it, does a story come around that may be true, may not be true. It is, you have to have an understanding of the business that you're in. And you have to know what is driving earnings, and only really by doing a deep analysis of the company. And you have to come up with, usually for earnings, there's one or two big drivers in there. And then there is some idea of valuation. So let's say you're looking at a company that has historically had a valuation of 18 times earnings that is now at 25 times earnings, and you've identified three drivers. Well, how are we going to keep it at 25 times earnings? You're going to have some idea of what these things need to come out at to justify the 25. Even if they're good, they may not justify 25, they may justify 22, and that thing is going to sell off. So you have to understand, what are the drivers of earnings, and what is the market pricing in for those drivers based on some historical average of a multiple? What is it pricing in? Because sometimes a company could be extremely undervalued, have earnings that seem and skyrocket, just jump in price because it exceeded low expectations. And sometimes a stock will sell off on good earnings because it wasn't good enough to justify the valuation. So you have to keep two things in mind when you're looking at earnings. Where is this stock valued, and what needs to happen to justify this valuation or even push it higher? So good companies do not necessarily always make good investments, especially if they're overvalued, if they're already overvalued and priced for absolute perfection. Tesla, anyone? When it was in the $400 range, it got a rare downgrade today. I'm surprised that somebody even had the courage to do it. But it has a valuation as if everything he says is absolutely going to happen when he says it's going to happen, and that there'll be a Tesla-only future, and there'll be 100% of every market that they're in, and no one can compete. Now, is anything priced for that? Is anything priced for that? Even at 392, 391 now, it's still massively overvalued. How were you seeing the term? Oh, we answered the term premium questions. To which extent one should deep dive into the world of coding? Meaning, where should one stop learning and start mastering? I want my coding journey to be very consistent with finance only, and want to learn which would be helpful in my finance journey. For now, I've planned out this pathway. Learn Python basics, master data science and analysis, then go for ML deep learning. Well, learning is don't think of learning as a highway. where you head out on the highway and you start going. Learning is more like a city that was built without planning, where streets kind of just do this all over the place, right? And then maybe it comes back here. Look at this? I'm drawing Costa Rica. There. If you ever driven in Costa Rica, that's exactly what it is, a city without planning. Think of learning as a city without planning. Where one road, as you're going down the road, there's a whole bunch of roads that branch off. That you may say, well, this looks interesting down here. And you head down another road, which has a whole bunch of other roads that branch off. And you say, well, this one looks interesting here. I don't know that I would map out a 4-year learning path as if it were one long highway. Just start learning, and take the forks in the road where you see more interest, or something that pulls you one way or another. Explore. And that's what learning is about, is not just one pathway, but just explore. So I don't have any general advice other than just start learning and let it take you where it takes you. Be open to, learning new things as you go along. How would Canadian apartment REITs be affected by Pierre-led Conservative government? Housing Act would require major cities to increase the number of homes built by 15%. Well, there's saying something and there's getting it done. And then there's the time frame from saying it to getting it done. Compound annual failing to meet this goal would result in a proportionate withholding of federal funds. The promised conservative policies, combined with a backdrop of lower immigration, are negative to REITs, but good for young Canadians. I don't see them as being negative for REITs. No, if we're talking about apartment REITs, you still have a structural shortage of housing. I just don't see why this would be negative for apartment REITs. You can rent an apartment or you could buy a house. It's still going to be rather expensive to buy a house. You still need a down payment to buy the house. You can't escape that. You still have to pass the stress test to buy the house. And even if you incentivize municipalities to build, there's saying it, and then there's actually getting it done. Things just don't move that quickly. Now you can try to make them move quickly by removing a whole bunch of regulation, but sometimes it's not really up to the Fed; it's up to the province. So if you want to build in Ontario in what's called I guess they call it the green space or the green zone, you can't. No matter what the federal government says, the province of Ontario has jurisdiction over that. So you got to get all the provinces on board. So you can work towards it and say this is what we're doing, but you'd still be, just because you get an election in May perhaps. New leader, June, July, June. Give it 2 years before you actually start to see traction on any real policy. You got to get everybody on board. No, I don't think because somebody has an idea in their head who is not the leader of the country yet, that suddenly this is going to be negative. I just don't see that yet. Mara started lending their Bitcoin to third parties to get a yield on it. Yeah, I'm aware of that. And expecting in long term can pay operating costs with that yield. I know what they're doing. I have a fairly good idea of what they're doing. The only thing they could be doing, which means I think in time, with the new head of the SEC, with what they're doing something in a roundabout way, not in an illegal way, just they're going through a third party to get something done. And it's short term, as they say, it's short term. And of course it would have to be short term based on what they're doing. I'm not going to tell you what they're doing, because I think tomorrow I will post the Understanding Bitcoin Mining, and in that video, I will say what they're doing. because it is a potential source of revenue going forward, but not just for one, for everyone. For everyone. It opens the door for everyone to make money on this, but because it opens the door for everyone to make money on this, as soon as you have a whole bunch of supply of loanable Bitcoin, it drives the yield way down. So no, I don't think that Mara will be able to cover their costs, because it is not a strategy that is proprietary to Mara. It is not based on relationships they have that no one else has. It's not based on that. Why not just buy Tesla put? Yeah, I had Tesla puts before, and had I kept my Tesla puts, I would have lost it all. So whenever you buy puts or you're short, you must be tactical. You can't just sit back and wait. You have to be tactical, especially in these markets, and especially with a cult name like Tesla. I feel like sometimes you close positions early when they are showing red in your portfolio. But maybe if you just commit to buying a put and accept that you may lose that amount, your psychology may be different. I don't know. With the size of the portfolio I have to buy in a certain size for it to even be meaningful. It's not like I can buy one put and let it go. I have to buy in a size that's meaningful. So I've got to make, at a minimum, $40,000, $50,000 bet on puts for it to even be meaningful in the end. Tesla just, the fundamentals support a lower price, but my God, it's a cult stock, and it's just is Musk there? Then that's all that matters. Don't bet against Musk, and you can say, well, look, I'm not betting against Musk. I'm betting against the valuation. Even if he gets everything done that he says he's going to get done, he's not going to be 120% of the market. The valuation is suggesting he'll be 120% of the market. That simply can't be done, right? The forecast of having more robo-taxis on the road than the number of cars that currently exist on the road today is a ridiculous assumption. That's not betting against Musk. That's betting against a valuation that's ridiculous. But still, it has a large retail following that does not care about valuation, only cares Musk price go up, Musk price go up, Musk price go up, and that's what you're fighting. Think about it this way. I could put a 10-year-old kid in the ring with Mike Tyson, and it would be brutal. It would be brutal. But if I put 50 10-year-old kids in the ring with Mike Tyson, they're taking him down. Not even he can stop a swarm of 50 10-year-old kids. That's what you're dealing with when you get into the retail space in this group. It's like fighting off thousands of 10-year-old kids all at the same time, right? They're generally uninformed about how to fight Mike Tyson. They're going to get hurt one-on-one. They will all get hurt eventually, but they're going to take him down. He cannot fight that crowd. Same thing with the retail investing crowd. When they get a hold of something, it's like fighting 10-year-old kids, a swarm of 10-year-old kids. Each one independently hasn't got the skill set to be there, but collectively as an army, you can't beat them. So why would I willingly say, okay, I don't care about this money anymore and just throw it away when I could put it on something else? I've tried my short on Tesla. Overall, I escaped, I think, unscathed, but I didn't make anything on it. I didn't make anything significant. Didn't move the needle for the amount of monitoring and work I had to do on that thing. I'm not interested. I will sit back and just, collect bragging rights when it fails to perform. What do you think about the next phase of AI, quantum computing? Feels like AI is old news. Quantum computing is the next big thing. For when? AI hasn't even shown up yet. Quantum computing hasn't even shown up yet. It was one company that got a stable qubit, from what I can understand, which is a long way from it suddenly being in Best Buy by December. You're not going to have a quantum computer laptop for Christmas. What are you, 10 years, 15 years away from any of that happening? Right? So no, right now it's all just hype. It's all hype until you show me something, until you show me a product and you show me what it can do. Right now, it's nothing but hype. It's nothing but hype. That's all it is. That's all it is. So I don't think anything of it, and I'm not interested in it at this point. Any alternatives to TLT that could be traded by European investors? I know that Europe has some issues with US tickers. I don't know the answer to that because I'm not in Europe, so I've never had to find my way around it. So I don't know the answer to that. Tried looking for some, but the vast differences between the returns with those seemingly similar ETFs is throwing me off. At the moment, I'm invested in the 25-year US strips myself, but I'm wondering if there is any better way to gain exposure similar to TLT. I wouldn't know that because, again, I've never been in a situation where I've been forced to find my way around it. No job experience as an analyst except personal investing experience for a little over 1 year. I've been away from the workforce due to MVA injuries. Don't know what that is. 3 or 4 years past CFA level 2. Finding it hard to get my foot in the door. Trying to pick a sector industry, start preparing my research reports to accompany job applications. I'm in Australia but expect to move to USA in 2 to 3 years. Any recommendations, advice in general for job search and sector industry selection? I am far removed from the job market, my friends. Anybody out there asking me for career advice or how to get a job or what to do, I am so far removed from the job market. I don't know what people look for. I don't know what companies are interested in. I don't know. I have no idea what they're looking for anymore. I am that far removed from it. Like I am, if you think about, entering the workforce versus leaving the workforce chronologically, I am far closer to leaving the workforce than entering the workforce. When I entered the workforce, it was a very different market altogether. And I was more aware of, what the market was looking for, but I never got a job. I've never actually had a job. I mean, I've worked for universities, but those aren't jobs. I mean, being a professor is not a job. It's not a job in the sense of a 9 to 5 or, a career where you're, you're in the office at 6 a.m. to 6 p.m. every day. It's not like that at all. Universities, maybe you show up at the university 15 hours a week. It's the easiest job in the world, really. So I can't help you on these. I really have no advice that is tailored to the job market because I'd just be guessing. I don't know what they're looking for. Stopping the EV mandate is exactly what it means. No legislation to require electric. Regulatory credits will likely stick around, especially if Musk has anything to say about it. Okay, well that was my question: is would this affect the regulatory credits? Because that is if you look at cash flow from operations for Tesla, if you take away those regulatory credits, you pretty much take away their cash flow from operations. Is it once or twice in a decade type of opportunity to enter long duration? Missed to buy during 2020 crash of stock market. Don't want to make the same mistake for bonds. Well, I have my allocation of bonds. And as one comment said earlier, it's been painful. It's bloody painful. Let's just see where we are today. I think we dropped all the way to 86 on the day. I no longer look at it because in my mind it's a long-term hold, and I have the patience for it. I think it's just a matter of time before Trump shows up and beats the hell out of Powell to push it down. 86.05. We're up 13 cents after hours. Not much. One of the themes I said that you can expect for 2025 is volatility, and my God, we've got volatility out of the gate this year. And I think once Trump gets in office, that volatility will continue. It will continue. He'll say some things that drive the market up, and then the next day he'll say some things that drive it straight down. If you don't have an account on Truth Social and you're not following Trump, you're missing everything as it happens, because he doesn't go through the press office. He doesn't do press releases. His press release is Truth Social. Truth Social. You got to have an account on Truth Social. I hate to say it, but you got to have an account there. And you got to have an account on X, and you got to follow Musk. All right? You got to figure out what the co-president is saying. And keep calling him the co-president. Everywhere you go, keep calling Musk a co-president. If you want to see a relationship blow up really fast, let Trump know that everyone thinks Musk is the co-president. He will distance himself so fast. Trump does not share the stage. He does not share the stage. That will end badly unless Musk steps back into the shadows and lets the glory and all the light shine on Trump. That will not end well. He will end up with a crown of thorns on a cross, crucified. I'm telling you. Thoughts on stable coins? Would you deem these another hoax? Well, not really, because, I mean, if they are back, it's a matter of, well, who's the sponsor of the stable coins? They haven't worked out well in the past. There has been some irregularities, let's say. Stable coins would be a threat to smaller markets. Stable coins would be destabilizing, I think, to countries that have capital controls on their currency. In other words, you cannot convert our currency into US dollars. I think that's where stable coins would have the greatest impact, because that is exactly what would happen. I can't convert my money into US dollars, but I can go online, I can go on to the crypto exchange, and I can buy stable coins. Well, you basically bought a US dollar, right? So what is it going to do? It's actually going to increase the global footprint of the US dollar. And if you can circumvent these capital controls, some countries have them in place for a reason, you could destabilize a lot of the smaller countries of the world with stable coins, unless those countries eliminate the possibility of that happening. I think in the end, the only real cryptocurrency I would use is a central bank-backed digital currency. It would be the only one that I would use, because I have dollars. What do I need a stable coin for to have a dollar? Hey, I'm going to convert my dollars into stable coins so that I always have a dollar, so I can convert them back to dollars if I need to spend them. Well, what's the point of that? I mean, I already have dollars. I already massively outperform inflation. Well, what do I need this stuff for? Like, it is an elegant computer science solution to the Byzantine general's problem. And as far as a paper in an academic journal, brilliant. As far as winning a prize, whether it be, what's the big prize in computer science that's given out? Not the Fields Medal, that's math. I forget. There's one prize. Give him a prize. But, just because something has a technical solution that's elegant doesn't mean it has an economic solution. What economic problem is it solving? And you can point out a whole bunch of problems. Oh, this, that. And I would argue back that, well, those are all small use cases that are best handled with a permissioned blockchain, not a permissionless. So in the end, I don't see the economic value of any of this stuff, right? I just don't see it. And if there is economic value, the incumbents, your trusted third parties, will jump all over it. They'll just wait for the market to be proven, and then they'll move in. They will own it. Not all of this stuff out there. So I don't want to call a stable coin a hoax. I think there's something in there that if you give me a whole bunch of US dollars, I'll give you these coins that are linked to those US dollars. I'll guarantee you that I will buy every coin back from you for $1. I will put all that money into 3-month T-bills. Thank you for the 4.2% I'm getting off you for free. Oh, you want your money back? That's fine. Here are your dollars back, and you give me these stable coins and I'll retire them. Right now, if you could, what would be interesting is if you could buy one stable coin. We'll just call it an SB or an SC, one stable coin. And over the course of the day, you can see, because the stable coin is backed by a 3-month T-bill, you could see the value of the stable coin increasing every day with the accrued interest. So suddenly my one stable coin after a year is now 1.042. I can get $1.1042 back off it. In other words, I'm buying a $1 bond, a $1 T-bill. I can buy a $1 T-bill and see the value of my currency increase every day. as opposed to it just being stable. It actually increases every day. I actually get some of that. That might encourage a higher savings rate. That might be because now it can be game-like of how much is my coin worth today? How much is it worth today? Right, based on this. I don't know. If imagine the central bank digital currency, or the central bank just paid, rather than paying banks interest on reserves, it paid savers interest on their stable coin. I don't know, that starts to get something to be a bit more interesting. But I think the stable coin would be a great money making tool for the bank or whoever that issued the stable coin. Please show us how to invest in U.S. denominated sovereign bonds on Interactive Brokers. I don't have IB open, but you just click on, there's icons across the top of the main screen. You just click on Treasuries and the window pops open. We learn how to price it throughout the CFA journey, but when I check on IB, I get nervous, fearing that I'm missing something. I see Brazil sovereign bonds, 3 months offering 13% yield. Looks like amazing opportunity. Despite the noisy fiscal, Brazil is in a strong macro position. 95% of its debt is domestically held by pensioners near investment grade status. I think that through that window, you will see a bunch of bonds that are listed. Many of those are still over the counter, which means you still need a dealer. IB is listing them, but when you put your bid in, it's not going to any exchange. It's going to a dealer desk. And if there's no volume at the dealer desk, then you don't get anything. Or if the dealer doesn't like your price, you don't get anything. With $50,000 available to invest, how would you go about deciding if it's better to buy $150K worth of SPY? I don't think you can get 3-to-1 leverage or buy good leaps. No, don't buy leaps, because you have the risk of those expiring and then being worth zero. Buy SPY. Buy SPY. You don't need leverage. If all you have is $50,000, you're not in a position to bet it all on leverage at all. How likely do you think it is, and to what extent are you concerned that Trump might say he will not pay the U.S. debt? Oh, I don't think that's much of a concern. I think he'll threaten it. Why are we paying this country back when they rip us off so much? I mean, they don't want to. They don't want to do fair trade deals. They don't want to do this. They don't want to. I don't think we should pay them back. I think that would be a negotiating tactic. I wouldn't put it past him to float it out there. But hopefully he'll have enough smart people around him to say, if you even say that shit, yields on our debt would skyrocket and it would crush our fiscal position. If you even say that shit, if you're going to say it in a closed room where nobody can hear you, right? I hopefully he'll have people around him that can temper him, but I don't know. Somebody around him should have said, "What did you just say? You're not ruling out military action to take the Panama Canal? Did you just say that?" You know, I think there's some people probably banging their foreheads on the desk right now going, "Oh, come on." But he did say it. I was going to play earnings this week, but I'm positioning for the Trump pump. I have a feeling his stock is going to sell off after the inauguration. I don't know. I think Trump has Truth Social, and he's got a lot of money, a lot of his wealth tied up in that thing. And the advertising is going to go to where the eyeballs are, and he's not going to open an account on X and give Elon Musk his audience. If anything, expect to see an account on Truth Social with Elon Musk on Truth Social. He will fall in line. He will fall in line. So no, I think Truth Social will get millions in growth in number of eyeballs on the site just to get the press releases, because Trump will not go through the White House press office. 3 a.m, he'll just say something on Truth Social, and there it is. There's the policy. Do a simple calculation. Real GDP growth plus inflation. We get nominal yields around 5.4. Nominal yields on what? I imagine you must mean the 10-year if you're doing this. You must mean the 10-year of 5.4. inflation, you got to look at a 10-year inflation break-even. And let me give that to you. We can look at the 10-year inflation break-even. We're sitting around 2.3 right now. 2.3, so 3.1. You're saying that real GDP growth over the next 10 years will average 3.1%. That's a tough one. I don't think so. And you're also saying that inflation over the next 10 years will average 2.3%. Now, we can debate about that. Or is it that the Fed cut projection? I don't understand that point. Lower rates or long-run growth of 1.5 plus 2.5 is 4%. Lots of periods in small sentences is 4% yields, period. Long-run growth, period. And on future growth, period. I don't know how to read this. I'm watching one in GDP versus real yields, period. For signs of recession and growth, period. I'm not sure what you're saying here. We get nominal yields around 5.4%, so a higher yield makes sense. Or is it that the Fed cut projection? Or is that the Fed cut projection? I don't understand that. That lower rates or long-run growth of 4% yields, long-run growth, and on future growth. Okay, I'm lost. I don't know where these sentences begin and end. I'm watching I in GDP investment versus real yields for signs of recession and growth. Recession and growth for signs of recession or growth. I'm watching nominal GDP and income for stock market direction. Fed policy and monetary policy. Let's see where this goes. How do I watch M2 and where do I find Trump policy like future GT fiscal policy? Okay, I'm sorry. I don't know what it is. I can't follow this. I'm just going to pass. Can you explain your Capri investment and why you're repeating what you did in the summer? This is my third or fourth time doing this now. I like Capri. Capri is an apartment REIT with reasonable rents across different cities. They're not at the super high end. High occupancy rates, and they're selling at a discount to their net asset value, which is lower than the average discount to net asset value that they've experienced. So they're selling at an even deeper discount to net asset value, and I don't think that can hold. So yeah, I'm comfortable holding it. Now, does that mean they're going to run the $55 in the next month? I don't think so. But will they find their way back there over, let's say, if I say 12 months? Yeah, I think so. So they're 43 now to 55 is what, 30% of the upside, along with a 3-point-something% yield. So I think that's better than cash. I'm willing to wait. It's worked in the past. Apartment buildings aren't going away. You can't outsource apartment buildings. AI is not going to replace apartment buildings. Quantum computing is not going to replace apartment buildings. GPUs aren't going to replace apartment buildings. They're not going anywhere. And that's it. For the person who asked the question with a whole bunch of short sentences, maybe ask again. I think you're getting confused between the current inflation and the current growth. If you're looking at the 10-year, you have to look at the average level of GDP growth over those 10 years and the average level of inflation. And when I say the average level of inflation and the average level of growth, keep in mind that you're not just going to get this, right? You have recessions, right? So you have to factor in over the next 10 years, are we going to have no recessions? No recessions at all? Right? All right, that's it.